Uncovering the economy's invisible hand in the unseen dance of demand and supply. Every economy is governed by an invisible force that quietly orchestrates the flow of goods and services, directs the development of countries, and has a significant impact on our day-to-day lives. Trade with major institutions requires understanding price movements, supply and demand dynamics, and market dynamics. Understanding price movements and market trends is crucial for capitalizing on opportunities. Traders must recognize risks and constant bank profits to navigate the market and make informed decisions. Staying updated on bank profits provides valuable insights into market trends and potential profit opportunities. Millions of market participants place millions of orders, driving the order flow and creating price action on charts. This pattern creates repeating patterns that can be profitable. Understanding these patterns helps explain why currency exchange rates fluctuate. The price of currency pairs is determined by the agreement between buyers and sellers, with buyers exerting upward price pressure and sellers exerting downward pressure. The market operates like an ongoing auction, with manipulation being a potential method. Liquid instruments are traded through bidirectional auctions or block orders, with the order book on the left showing the volume demanded at each price level. The right side displays the ask price, which is the bid from the seller. Transactions occur when both sellers and buyers agree on a price, and both must execute an order. Buyers bidding on a lot and sellers selling it, with buyers offering or sellers asking for it. Markets operate differently, with passive or aggressive orders. For example, to sell 10 lots, there must be a buyer willing to pay the asking price, and vice versa. Passive traders use limit orders, waiting for the market to catch up. Aggressive orders, on the other hand, involve buyers and sellers crossing the spread to buy or sell at the offer price. This interaction, known as order flow, occurs when both passive and aggressive orders are present. In a live market, an institutional buyer wants to purchase 10,000 lots at the best asking price, but the market is at a fair value due to the imbalance between supply and demand. A study of markets often reveals that the perfect time to buy an asset was yesterday. Isn't market a big scary place? Trade with major institutions requires understanding price movements, supply and demand dynamics, and market dynamics. Understanding price movements and market trends is crucial for capitalizing on opportunities. Traders must recognize risks and constant bank profits to navigate the market and make informed decisions. Staying updated on bank profits provides valuable insights into market trends and potential profit opportunities. For more content like this, subscribe to our channel Finance Explained and stay updated in today's hustle and bustle of the world. Institutions cannot hide the massive imbalances they cause in the market. To trade with the order flow, traders must spot their tracks on a chart. On a candlestick chart, aggressive buyers push the price higher until they find enough supply to meet their demand, while aggressive sellers liquidate offers to push the price higher. When there is an overwhelming imbalance between supply and demand, markets move in search of new liquidity to recover their prices. To identify supply and demand zones, traders wait for the price to return to the demand zone, where previous institutional buyers have a vested interest in ensuring the price doesn't go lower and maintaining their position. The market's order flow continues in one direction until there is an overwhelming imbalance in the opposite direction. The price moves out of range to the downside, creating a supply zone supported by institutional price participation. The market moves low enough to discount prices, where demand dominates the supply, and the market sustains a sustained flow of bullish orders. Higher probability trades will always align with the automatic flow. There are 3 types of bids and ask zones: range, pivot, and buy now sell. These zones help traders navigate the market and maintain their positions at a profit. To buy low and sell high in a market, aggressive buyers cause an overwhelming supply to demand imbalance, leading to price breaks out of the upside range. To create demand zones, traders wait for the price to return to the demand zone, where previous institutional buyers have a vested interest in ensuring the price doesn't go lower and maintaining their position. The process involves a 4-step process: range, start, mitigation, and continuation. The market's order flow continues in one direction until there is an overwhelming imbalance between supply and demand in the opposite direction. The price moves out of the range to the downside, creating a supply zone supported by institutional price participation. The market moves low enough to discount prices, where demand dominates the supply and the market sustains a sustained flow of bullish orders. Higher probability trades will also align with the automatic flow. There are 3 types of bids and ask zones: range, pivot, and buy now sell. These zones help traders navigate the market and maintain their positions at a profit. The buy to sell method is not strictly enforced, as it can lead to drawing demand zones on Buddhist candles and vice versa. For a demand zone, the push candle should close above the high of the previous candle, while for a supply zone, the push candle must close below the low of the previous candles. Refinement leads to higher precision, smaller stop losses, and higher risk-reward ratios, but it also increases the likelihood of mistakes. To perform long-term, it is recommended to always take the pivot of a single candlestick. The market is made up of orders trading against each other, and understanding the fractal nature of markets allows for the visualization of price action in different time frames. There are 3 types of bids and ask zone fractals: inside bars, sell to buy or buy to sell foreign wixoms, and buy to sell wick zones. These fractal refinements represent lower timeframe zones on a timeframe, and it is recommended to ignore these refinements and focus on the pivot and range zones in the same timeframe. The 8 key areas to focus on are fabric breakdown, reversal zones, sweep zones, and supply-demand interaction. Fabric breakdown is the most significant filter, and it can cause the next swing structure breakout. A high-demand zone breaks the swing neckline, while a reversal zone involves a high probability of a bid turning into an ask. Sweep zones are also important to consider. These zones occur when a large number of orders are quickly filled, indicating potential market manipulation. Supply-demand interaction is crucial, as it determines the overall market sentiment and can help identify areas of strong buying or selling pressure. By analyzing these key areas, traders can make more informed decisions and increase their chances of success. Why is it important that liquidity be captured and taken from these areas as it is created? In order to trade against them and experience the least amount of slippage when they enter and exit the market, institutions need opposite liquidity. There will be a lot of sales orders below this level because if they are buying, they need a lot of supply to do so. These orders are generated by early buyer stop-loss orders as well as emerging traders who are attempting to sell at that low. But the institutions are aware of this and will use the sell-size liquidity behind that low to take a long position. Therefore, the presence of a sweep zone denotes institutional involvement in its creation. Number 4 is liquidity, which refers to the availability of liquidity in a zone for institutions to enter the market with minimal slippage. Without liquidity, these zones often become trapped and fail. The more zones stacked across timeframes, the more orders there should be, increasing the probability of a move. Number 6 is alignment with higher time frames. As more time frames increase the probability of a trade, the M15 is bullish, and the M5 is likely to turn bullish as well. Multi-time frame analysis helps avoid losses by focusing on areas with good prices, discount pricing in the lower 50 range, and premium pricing in the upper 50 range. This unmitigated zone, a brand new or touch zone, is the strongest move when the price mitigates it. Combining these influences gives the most likely institutional demand zones to trade. To identify high probability zones, set a limit order directly, wait for a reversal candlestick formation, or use a lower timeframe structure breakout for more confirmation and increased risk reward. Before entering a trade, it's crucial to know how and where to exit. To achieve consistent profitability, use the fixed R method, which aims for the same amount. This set and forget approach helps maintain emotions and avoids cutting and switching between technical targets. Trading is a game of odds, and the fixed R method helps put the numbers in your favor. And that is a wrap for today, folks. I hope you enjoyed this video, and if you did, make sure to smash the like button. Subscribe to our channel, Finance Explained, for more such informative videos. Don't forget to press the bell notification icon to never miss an upload from us, and I'll see you in the next one.